Good morning, everyone. We are waiting for some other participants to join. We'll be starting in another 3-4 minutes.
I think we'll wait for another 3-4 minutes and then we can start.
Yes.
So I think we can start the meeting now. So good morning, everyone. I would like to thank you firstly for joining on a Saturday morning. So I'm Nitish Rakecha. Recently joined this business, Royal Eastern Financial Services, after completing my MBA from Nasi Manji three in March, and little bit about the company and the founder as well. So we provide end-to-end financial solutions after assessing the risk appetite and the financial goals of our clients. And about the founder, he started this business 7 years ago in 2015. Uh, After completing his MBA from IIM Raipur, he thought that this financial space has a lot of potential in it, and he can definitely help a lot of people managing their funds and diversifying their portfolio in the right asset classes to grow and manage their funds in a better manner. Now, we are going to take a poll of just two questions, which will be uh, displayed to you on the screen very shortly. I think we can take the poll later on, and my brother Piyush Rakesh can carry on from here.
Thank you so much, Nitish, and very warm good morning to each and every one of you for taking your time out and attending this meeting. So, mutual fund industry has grown from 8 lakh crores in 2013 to about 41 lakh crores in 2023. That's about 5 times in 10 years. Largely, this growth can be attributed to SIP inflows. The monthly SIP book today stands at about 14,000 crores, and each one of you has to be appreciated for that, because I think you have chosen, and it's the right choice for mutual funds or SIP as a vehicle to achieve your long-term financial goals. Alternatively, there is another investment which is called alternate investments, which is also growing at a very rapid pace. This industry is growing at a CAGR of 50% in the last 5 years. So what are these alternate investments? So alternate investments are private equity, venture capital, art and antiques. And thanks to technology, there has been new investment opportunities which has opened up, like fractional real estate, invoice discounting, private debt, and P2P. So today we are going to talk about P2P. So most of these alternate investments are not linked to the equity market or to the bond market. So when I say that they are not linked to the equity and bond market, I mean that with the ups and downs of the market, these investments mostly stay immune. They have no direct correlation with the equity or the bond market. So these alternate investments can be a good choice to diversify your investment portfolio. So today we have a very special guest. As I said, I will be talking about P2P today. We have a very special guest, Gautam Adhukia. He is the founder and CEO of Liquiloans. Liquiloans is one of the prime investment opportunity or a P2P company in this space. It started in 2018. Gautam has done MBA from IIM Calcutta and holds a charter in CFA. Now, Gautam has had a stint with IIFL Wealth for 4 years. Then he started and thought that he would start on his own, and he founded a company called Rento Mojo. Most of you must have already heard about this company. This is a very popular furniture renting company. Gautam was a co-founder of this company. In 2018, he also founded this company called Liquiloans. So Liquiloans, as I said, is a prime player or one of the leading players in P2P space. So now I would, without any delay, I would now request Gautam to take us forward and take us through talking about how P2P works, what returns can we expect, and what are the risks associated when we invest in P2P. Over to you, Gautam. Harish has Gautam joined?
Yes, he just joined the meeting.
Yeah.
He'll start in a couple of minutes.
बाकियों का ऐसा अलग दिखता
You have joined. Should we start?
Yeah, you can start.
Okay, great. Piyush, couple of questions before we start. Would you be able to help me with what is the background of the audience in terms of understanding of P2P? Are they investors already, or is it largely a set of audience who will want to understand everything?
Yeah. They are a mix of my existing investors and also some people who are interested to know more about P2P. Some are very new to this space. They might be investing already in mutual funds, equity, bonds, but P2P could be new to them. So it's a mixed crowd of both kind of people.
Got it. Okay, great. Fair. So what I'll do is I'll start with a quick background of how P2P started, not just in India but globally. What was the genesis of this industry for the first 10 odd minutes, and then I'll spend another 10 15 minutes on what we do at Liquiloans, and then we'll open up the floor for Q&A. In the meanwhile, also I think Anandam from our team is there. If the audience has any questions, please feel free to keep posting it on the chat, and we take them up together after the session is over. Okay, so broadly, I think P2P as a category emerged in the UK and Europe and US at the same time. This was around the year 2005. The genesis of this industry was very simple. If you think of even the Indian context, right, when you go to a bank and do an FD, you get a FD interest rate of about 5 to 6%. When you go as a customer to the same bank and ask for a loan, the bank tends to give you a loan at 14 to 15% if you go for an unsecured loan. Obviously, home loans and auto loans are cheaper, but unsecured loans, credit card loans, personal loans are at a much higher price. So there's a fairly large spread or a gap that you get as a borrower versus as a saver with the same bank. And this is the same gap that these P2P platforms set out to extinguish or reduce. I've just muted the gentleman for a bit. This was around the year 2005. In fact, Leonard LaPlanche was the founder of Lending Club, which is the largest P2P platform in the world, was one of our angel investors in my previous startup. So I got a very first-hand understanding of what prompted him to start. So his story was very simple. In the US, the gap is even larger, right? So when they go and do a FD with the bank, they tend to get about 1.5% in terms of interest rate. And typically, most startups end up borrowing on the founder's credit card. So there he was being charged 19 to 20% as ROI if and when he did not make the payment on time. So he realized this is a very large gap, which in today's day and world, right, where everything is digital, money is moving with a click of a button, you don't necessarily need a very expensive branch setup to be able to collect funds from investors and disburse the funds or give out loans to borrowers. If you could build an online platform which connected both of these counterparties, where investors would come or lenders would come and invest their money, and at the same time, borrowers could come and make a loan application on the platform. If you could connect these two digitally, you could bring down the costs of operating or concluding this transaction substantially, and thereby make it more rewarding for the investor, and at the same time, bring down the cost of borrowing for the borrower. So this was the thought process or the genesis of the idea of P2P lending. For about 2-3 years, these platforms started to scale between 2005 and 7. But 2008 was truly the inflection point for some of these firms, right? So if some of you remember at that point of time, the global financial crisis had happened. What ended up happening as a result was a lot of these banks who were saving their funds or were at a paucity of supply of funds started pausing their disbursements to potential borrowers. So anyone who wanted funds at that point of time was finding it difficult to get a loan from bank. And that became the impetus for P2P platforms to gain much greater scale. Some of these came on board and started seeing humongous growth on the platform. So again, 2008 to 2010 was the prime period for a lot of P2P platforms. They scaled quite well. And eventually over the last 10 years in certain geographies, they've started becoming as big as banks, or in certain cases even larger, especially when it comes to certain loan categories. In the Indian context, P2P platforms have existed in an unorganized, regulated manner since about 2013. 2017 October is when RBI came out with guidelines on how P2P platforms are supposed to be licensed and operated. That became the trigger for us also as a business to set our foot in the ground and apply for a P2P lending license. In India, the context is similar, where there's a large spread between what a lender makes to what a borrower borrows at, especially when it comes to the unsecured category. And the same the cost dynamics apply, right? Setting up a branch for a bank is fairly expensive. You need 20, 30 people working there. Lease costs are fairly high and so on. But for a retail loan, which is for people, any loan that people like you and me are taking, you don't necessarily need a branch. A lot of the things that are required or go as inputs in taking a loan can potentially happen online. So with the same context, we also got into this line of business. How P2P platforms work is very simple. As per RBI guidelines, any P2P lending platform has to set up a escrow structure where any investor coming in parks their funds or monies in an escrow account with close to zero counterparty risk on the P2P lending NBFC, right? So the structure that RBI has put up for P2P lending is very similar to what happens with mutual funds, where whether you invest with AMC A or the AMC B, you are not taking a counterparty risk of the AMC itself. You are taking a risk of how they perform. If they perform well, your returns are higher. If they perform badly, your returns are lower. But if the AMC were to cease to exist for whatever reason, your funds are continuously safe because they lie in a separate escrow account, which is managed by a trustee. A similar structure is what RBI has replicated here. When you're lending to hundreds or 50s or hundreds or 200s of people, it will be impossible for you to individually track them. But at the same time, if you do it by an escrow structure, your counterparty risk to the platform managing the escrow is close to zero. Piyush, I'll just pause this some more. Yeah. So with that same context, RBI has tried to replicate a very safe and simple structure where you're taking no counterparty risk to the entity manager. So let's just go deeper into how does this construct work. Lenders who come onto the platform transparently park all of their funds into an escrow account. If there are hundreds of borrowers on the platform, funds are disbursed from the escrow account to those borrowers. Those borrowers then on a month-on-month basis keep making EMI repayments. The interest from that is what makes a return for the people who have invested them. So all the funds from the borrowers come back to another separate escrow account, which is the borrower's escrow account. And the returns from that flow back to the lender's escrow account, and the lender makes a return on the funds that he has invested. This is how the P2P platforms in India work. Piyush, I'll again pause here for a minute if there are any specific questions, and then I'll go on to how the structure works in a little bit more detail and how have we operated on this platform.
So participants, I think, can post the questions in the chat bar. I think that will be better. If someone has any question, you can post it on the chat bar, and then those questions can be taken up accordingly.
Okay, should I continue?
Yeah, Gautam, I think you can continue, and we can take up the question.
Sure, great.
Yeah, we have one question from the participant. Just a second.
Okay, I've read through it. I think I'll address it through the presentation, Piyush, and if there's something that's still unanswered, I'll answer that. So this, we've not covered how we operate yet. So Probably
Yeah.
I'll answer this after.
Yes, you can answer this later.
Quickly about ourselves, we are probably the only P2P platform in the country who's gone and approached the credit rating agencies or CRAs for the rating. In the last go around, we were given a AA minus rating for the eligible pool of loans that were disbursed. Obviously, because it was a proxy rating, it did not get placed. About us, right? So we are like all P2P platforms in the country. If they want to operate, have to necessarily be regulated by RBI. We started our business in about 2018, and we partnered with around 1,600 advisors like Piyush Pan India, who've been advising their investors on investing into this. So this was started by Achal and myself. Achal has done his MBA from NMIMS and has worked with ICICI Bank, Citibank, as well as HSBC in the past. I've done my MBA from IIM Calcutta and have worked with IFL Wealth as well as Rento Mojo in the past. Both of us were earlier co-founders of a company called Rento Mojo, which is India's largest furniture and appliances leasing platform. Cumulatively in Rento Mojo across 3 or 4 rounds, we had raised about 300 crores of equity capital from Axel Partners, IDG Ventures, as well as Bain Capital. In Liquiloans also, as soon as we started, we were lucky enough to get a seed round of funding from Matrix Partners. Matrix Partners are one of the marquee VC investors. They've invested in Ola Cabs, Practo, Quicker, Tribo Hotels, and so on in the past. Kunal Shah, who's the founder of Cred and was the earlier founder of Recharge, came on board. Ashutosh Taparia, who's the MD of Famicare, recently sold his business for about cumulatively for 7,000 crores, became an investor. Abhishek Dalmia of Dalmia Bharat family in the north, and Satya Bansal of who's the ex-CEO of Barclays Wealth. Recently, we've also raised a small round of funding from Cred in their institutional capacity. This was mid of the last year. So about the product, right? So P2P lending platforms offer an opportunity for you all as investors to invest into an asset class which has retail borrowers at the underlying. And I'll cover this in a little bit more detail in the following slides, why retail investment is fairly safe and a good option. What does it solve for you? It is a high yielding product which is able to generate an alpha on your debt investments, gives 2-3% potentially higher than most of your other fixed income products. At the same time, it does not compromise on risk, right? So it's obviously easy to project a return which is 2-3-4% higher. But are you increasing the risk in the investor's portfolio? Are you minimizing the risk, or are you keeping the risk stable? That becomes the primary question to answer. Risk again gets mitigated significantly because at the underlying level, your money is disbursed across 200 plus names. So aapka counterparty risk to one borrower. One of the myths around P2P is कि I am lending to strangers, उन्होंने default कर दिया तो क्या? There are enough and more risk mitigants that we put in there. But at the outset, what we ensure is कि आपका पूरा पैसा एक borrower को नहीं जा रहा है. It is going across hundreds of borrowers. Your exposure to any one borrower is fairly limited. Returns are again fairly lucrative, up to 10.5%. Over the last 5 years, through COVID, we as a platform have had a 100% success rate, right? Not a single investor has, forget losing principal, has lost even a single basis point of interest on the investments that they made. So why should you even explore a product like this today, right? I come from a wealth management background myself. And as you can see here, most of the Indians prefer fixed income as an asset class, right? So although there's a lot of media noise and hype and a lot of coverage around equity, fixed income tends to be where most investors park their investments. As you can see on the right bar graph, about 3/4 of the capital that Indian investors have gets parked into fixed income, and only about a fourth goes into equity. But simultaneously, what's happened over the last 20-25 years when it comes to fixed income returns are FD returns, which in the 90s used to be 12, 13, 14%, have gradually come down. As recently as last year, they used to be at 5% and thereabouts. Last 1 saal mein, as RBI has increased rates have gone up. But again, in the last couple of weeks, a lot of banks have paused or decreased rates marginally. At the same time, inflation or महंगाई जो बोलते हैं has continues to remain sticky. That continues to be in the 6 to 8% range. Whereas FDs, which used to outperform inflation in the past, are no longer outperforming inflation. Which means if you park money into the safest asset class, which is fixed deposits, you are bound to lose money on a real return basis. Inflation has gone up by 8%. FD has generated a 6% return, that too pre-tax. So effectively, the value of your money year on year goes down by 1 to 2%. And as you can see here, in the worst of the cycles, which is 2000, 2001, 2007, 8, FD returns tend to underperform inflation by a higher margin. Yeah, this is what I was speaking about. Every time there's a crisis, RBI tends to reduce rates, which means FD rates also come down significantly. But inflation doesn't necessarily come down in those periods, which means your real rate of return is worse in the times that a fixed income product is supposed to protect you the most. Now we'll go into a little bit detail on how P2P works, why is it safe, what are the risk factors, how are we mitigating the risk factors, and so on. Right. So before that, you need to understand that koi bhi fixed income product mein when you're investing, how are you generating a return? When you're giving a money to a bank in the form of an FD, the bank lends the money further to either companies or to individual borrowers for a home loan, auto loan, car loan, bike loan, personal loan, and so on, and generates a return. When you invest into a debt mutual fund, when you invest into a debt mutual fund,
everybody please mute their speakers.
Thank you. When you invest money into a debt mutual fund, the debt mutual fund also lends that money in the form of an NCD bond subscription to corporates. Those corporates pay an interest on a monthly or quarterly or annual basis. And that is how a debt mutual fund generates returns for you. So it's very important to understand when any fixed income product or any debt product generates a return by lending the money further to a set of borrowers, the returns that the borrowers make or the EMIs that they pay and the interest that they pay is what determines your returns as an investor. Now, again, there's a very common perception that individual borrowers ko denge, strangers ko it's very, very risky. Large companies ko paise denge. They are here to stay. They've been around for 10, 15, 20 years. They will not run away overnight. It is safer to give money to corporate borrowers or corporate companies instead of retail borrowers. But the reality of the matter is very different, right? When you look at an overall level, the gross NPAs that, and we put the data for top 5 leading banks in the country here, 3 private banks and 2 PSU banks. As you can see, the orange bar graphs are the NPAs that these banks have seen on their corporate lending. Loans jo corporate ko diye, un pe NPA is shown in the orange bar graph. The loans that they've given out to retail borrowers are the ones that you see in the green bar graphs. As you can see across the board, each and every bank has seen a corporate loan NPA which is higher than their retail loan NPA. At an average level, weighted average level, their corporate loan NPAs are almost 5x of their retail loan NPAs. It's a significant difference between the corporate loan NPAs as well as compared to the retail loan NPAs. Now, why is this the case? There's an assumption then when you give to a loan to a corporate, it is safe, it is secured against the factory collateral receivables of the corporate. But as you can see here, right, when some of these corporates have gone bankrupt or the cases have been filed against them in the NCLT, 2 things have happened in the last 2-3 years, right? Out of 5,000 odd cases filed, only about 70% of them have been closed. And wherever they've all reached a conclusion, the recovery has been very, very tiny. Most of the cases that you see, which is the center bottom here, in almost half the cases, the average recovery is less than 10%. Wherever there has been a bid, companies have bid, corporate is in bankruptcy, we will take over their assets. The average recovery is less than 1/3. So, if 100 crore ka loan diya hai, so less than 1/3 is what the banks recover in case of a resolution. In case of a liquidation, where the company does not find any bidder, the banks tend to recover less than 10% of the overall money that they've lent. And about 1/3 of the cases don't even get closed, right? They're continuously in litigation. So from a bank's perspective, it takes years and years before they get their money back. So the assumption that corporate loans are safe because they are secured is not necessarily played out in reality when the security has to be invoked. So owing to this, you end up seeing this result. Now, if you go back to the previous slide, right, where in most of your assets, which be it FD, debt assets, be it FD, be it debt mutual funds, a majority of the exposure happens to corporate borrowers. Debt mutual funds, obviously, by regulation, cannot invest in retail borrowers. Banks are allowed to lend to both, but banks tend to do both, right? So they form out a chunk of their book by lending to corporates at a low rate. Their retail book tends to give a higher yield, but they have to give a consolidated FD, which gives a median return between. So now if you were to create an asset class which was only focusing on the retail borrowers that you saw out in the previous slide, then that asset class could potentially not only give you a high return, but would also be lower in terms of risk than any other fixed income product that you are investing in. So this again, let's look at the retail borrowing pyramid, right? We've carved out the set of people on the retail side and put them into different segments on a pyramid. So at the top of the pyramid are some of the HNIs. These are individuals who are really well off, who rarely do they need credit. अगर उनको loan चाहिए भी, they will need on their company books, not their personal books, right? If at all they borrow on their personal books, it'll be for something like IPO funding, that I have good amount of equity funds that I want to invest. I want to leverage them while applying for an IPO. Then there is the second segment, which is the affluent segment. This again is well-to-do. On a day-to-day basis, they never need credit for even a home loan purchase, home purchase, sorry. But they might use a Amex card or a Citi card for just payment convenience. The third segment is the proverbial Indian middle class, right? This is the aspirational segment, which again tries to live within their means. But kabhi bhi agar bada purchase aata hai, be it a large consumer durable, be it a car, or be it a home, they will necessarily need a loan. And they will then go to one of these players like ICICI Bank, Bajaj, or HDFC for taking up that loan. The fourth tier is rural borrowers or tier 3 borrowers. These are people in the rural space who are taking a loan for starting a business, who are taking a loan for day-to-day expenses. And the fifth tier again is mutual MFIs, right? So microfinance institutions. These will fund someone who's just starting their business, give them a 25, 50K, 75K loan, and hope that their business works and repayment will be made. So the fourth and the fifth tier typically borrow from names like Shriram Finance, Spandana, Fusion Microfinance. Where Liquiloans as an entity has focused is on the second tier and some part of the third tier of the pyramid. So people who are affluent and aspirational, again, generally do not need a loan for day-to-day purposes. But if they're going for a service which is slightly pricey, they might want to split that payment over a period of time. So this was the ability pyramid. This is split across depending on the income of the individual. Then there is the intent pyramid. Whenever you're giving a loan to anyone, be it an individual or a corporate, look at two things. Inka ability to make the payment is there or not, and unka intent sahi hai ki. If he has the money, will he actually make the payment, or will he run away, or will he hide and not try to avoid the payment? So this is the intent pyramid curve. This is typically covered by firms like CIBIL that you would have heard of. CIBIL score hota hai, Experian score hota hai, Equifax score hota hai. These are credit rating agencies for individual borrowers who give a score to a borrower between 300 to 900. The idea is higher your score, the more deep your credit track record is, the more repayments you have made across different products, and most of those repayments you have made on time. The lower your score, the more riskier you are as a borrower. Your intent is not fully tested, or if it has been tested, it is a negative where you have defaulted or delayed on your payment. So CIBIL will typically break borrowers into three tiers. 300 to 600 will be subprime borrowers. These are people who have in the past demonstrated some or the other lack of proper repayment history, have delayed or defaulted on some of their loans. The second tier is near prime borrowers, 600 to 700. Inka shayad ek do baar delay hua hai, but most likely there'll be a lot of people who have not made a lot of loans or not taken a lot of loans who will fall into this pyramid. Yeah, you have only taken one small credit card and have not used it very frequently, or you've taken one small consumer loan from Bajaj Finance at Coma of 20, 30, 40,000, and uske baad kabhi loan liya hi nahi. So a lot of those people will fall into this pyramid. Wahan history is not enough for CIBIL to give you a very high score. And 700 to 900 are considered to be prime borrowers, jinka enough and more repayment history is there, and that repayment history is impeccable. All the repayments or most of the repayments have been made on time. Even if there's been a delay, it's been a short one and has been rectified immediately. So the best quality borrowers are the ones who will fall in this tier. Again, from a Liquiloans perspective, this is the tier that we target. So people who have shown very high intent in the past and whose ability is also non-questionable. Now the point is, if you give a loan to these people who have very high intent and who have shown very high ability, the likelihood of them defaulting if they were to take a loan from Liquiloans or anyone else is very, very low. Now the immediate question that I'm sure will lie on some of your minds is, how is Liquiloans getting these high quality borrowers? And if these are so high quality, why are they taking a loan from Liquiloans in the first place? So that question is very, very valid. And this is the slide I'll explain how we source all of these borrowers, right? So for most of these borrowers, they will never probably even go to a bank for a personal loan. Bolenge ki hamara income is 1 lakh rupees, expenses are 50,000. It is enough for us to take care of our expenses. Only if I need to purchase a house or if I need to purchase a car, will I ever need a loan. But if you offer them a no-cost EMI loan, then a lot of these customers or these individuals will become takers of that loan. वो बोलेंगे कि Bajaj, if I go to a Croma, I want to buy a mobile phone for 60,000. I have two options: make a payment upfront immediately, or convert that payment into EMI at zero cost, 6,000 rupees into 10 EMIs, exactly the same 60,000 rupees, but paid out over 10 months instead of instantaneously. It becomes a no-brainer for a lot of people, right? You were 60,000, let me put into a liquid fund, earn 2, 3, 4% for the next 10 months and bring down my cost of purchase. And हर महीने 6,000 की EMI कटते जाएगी. So if I'm not paying a single rupee extra as cost, why should I not take up this loan? So a similar construct or similar idea we have replicated not in the consumer durable space like Bajaj so beautifully does, but in 3-4 other segments, in the upskilling education segment. कोई अगर NMIMS से या नरसिंह मुंजी से MBA कर रहा है या एक vocational course कर रहा है, that we will finance on no cost. If someone is doing a data science, machine learning, digital marketing course from Upgrad, or taking an EMBA from one of the international universities by Upgrad, that we will finance on no cost EMI. Second segment that we cater to is discretionary healthcare. So within healthcare, there are two use cases. One is fatal and second is non-fatal. Fatal may you go for anything which is necessary and has the risk of death for the patient. Non-fatal are considered, one sub-segment is discretionary use cases. किसी को hair transplant करना है. Someone wants a cosmetic treatment from VLCC. When a kid is born these days, people tend to save the kids themselves through a company like Lifecell for the next 10-20 years. If there is any medical emergency or medical issue which requires the stem cells to be used, those can come into play at that point. The third segment that we do is home decor. So anyone who is renovating their house, either from List Space, Design Cafe, Homeland, one of these entities, that we finance under no cost payment. And the fourth segment is fintech partnerships. We tied up with a large number of fintech players in the industry, through which we lend to their borrowers, where the risk is parked on their balance sheet instead of our balance sheet. Now, how do we evaluate these borrowers? You would see on the bottom left, where most of these are no-cost EMI loans. We look at the average bureau score. So average bureau score for all of our borrowers is 700 plus. Unka average annual income is about 9 lakhs. So on a monthly basis, our borrowers are earning 75,000 rupees. And the loan that they are taking from us at an average level is again below 50,000. So एक महीने की salary का भी loan नहीं ले रहे. Again, it tells you कि loan they have not taken because they needed to, but because it was available at no cost. And the tenure is also shorter, right? So you are mitigating the risk by lending to these high quality customers, not for a very long period of time, because I don't know where these borrowers will be 10 years down the line or 5 years down the line, income kitna hoega, expense kitna hoega. But in the next 12 to 24 months, their stability, income, expenses are quite predictable. The risk that you are taking is mitigated if you take a short-term risk. How do you evaluate these borrowers? First is a thorough background check in terms of CIBIL. What kind of loans have they taken beyond just the score? Have they taken a lot of personal loans or have they taken only secured loans? What has been their behavior in secured loans versus unsecured loans? How long have they delayed, if at all? How frequently have they delayed? Currently, are there any delays in their profile? So about 20-30 factors are checked within their CIBIL score. Then we check what has been their past education and where they're working right now. Where have they worked in the past? What has been their consistency and so on and so forth. Then depending on the ticket size, we'll also ask for a bank statement and do an analysis of their bank statement. What is their monthly income? How much are they spending? What are their savings? What is their average bank balance? What is the lowest that their bank balance has gone to? How volatile is their bank balance? And so on and so forth. Now, what tends to happen is the following, right? So a customer will typically go to a dealer, the one that you see on the right, and say, I want to consume this service for so many thousand rupees, or this, I want to take this package, which costs say about 80,000 rupees or a lakh of rupees. Now, at that point of time, the dealer partner will tell the customer कि आपके पास दो ऑप्शन है, आप पूरा पेमेंट 1 लाख का अभी कर दीजिए, या you apply for the loan via Liquiloans. If the customer says I want to apply for the loan, he will share 3 or 4 or 5 details with the dealer. The dealer's salesperson will punch them into the dashboard that we provide them. From the dashboard, they will be able to send the lead to us. As soon as the lead comes to us, we are able to, within a span of 5 to 7 minutes maximum, either approve the case or decline the case, because most of the system at our end is automated. It is not that individual underwriters are looking at the file from the scratch, right? Because kuch borrowers ka aap dekhenge, CIBIL report itself is 20 pages long. So it'll take at least 2-3 hours to even go through the report and make a summary. But the system can do that summary in an instant. So there's a backend algorithm which will determine which borrowers are great, which borrowers are bad. Any borrower who is great will get automatically approved. And this evaluation is done over 20-30 variables and is fairly consistent in nature. Anyone who's bad, the bottom 20-30% will get rejected automatically by the system. इनको तो loan देना ही नहीं है. Then lies the middle, जहाँ there are some good factors, some bad factors. The system will do the heavy lifting. वो पूरा evaluation करके एक manual underwriter को बोल देगा ये 3 factors are good, this 1 factor is bad. Can you evaluate the factor better and then take a subjective call on whether this loan should get approved or not? Now, if the loan is approved, I'll take you through the process after that. If the loan gets approved, the borrower then has to do 2 things. He signs a NACH on a NASH mandate, which allows us to auto debit his bank account on a monthly basis. And 2, he signs a loan agreement. How does the construct work? The use case or the product was worth a lakh of rupees. As soon as the loan is approved, the customer has to make a 20,000 rupee down payment to the merchant or the dealer. Because you need to ensure that the customer still has some skin in the game. He does not go out of the store by taking a 1 lakh rupee service or signing up for a 1 lakh rupee service at 0 rupees down payment. As soon as he gives 20,000 rupee down payment, you know he's a serious customer. There is some skin in the game. And the remaining 80,000 is what we are liable to disburse to the dealer. So we will disburse 80,000 rupees minus subvention, which is the discount that the dealer pays to us as a cost for onboarding this customer. So how do we make money? We make money from this subvention. Because I'm sure again all of you all will have this question on your mind कि अगर no cost पे loan दे रहे हैं, so how is Liquiloans as an entity making money? Liquiloans as an entity makes money because the dealer pays a subvention. We do not disburse the entire 80,000. Let's assume the subvention is 8%. So 8% of 1 lakh, 80,000 minus 8,000, 72,000 is what we'll disburse to the dealer. And the borrower will make 8,000 rupee EMI payments for the next 10 months. So 8,000 into 10 months, 80,000 is what he'll pay back. So we as an entity have disbursed 72,000 and 80,000 is what we receive from the borrowers over the period of time. That is how this subvention or no cost EMI concept works. So as an entity, then we say we get high quality borrowers from this segment. People who are well to do, have very high income, are taking a small ticket size loan, 50,000 rupees on an average, have 700 plus CIBIL score. They're signing up a NASH mandate, which if it bounces is similar to a check bounce case in case of default. And all of these customers are now provided onto the platform as an investor. As an investor, you can invest on any of the following schemes. Now I'll just take you through what are the investment schemes at our end. You can invest into a liquid scheme, which is available at a 8% up to a max 8% XIRR. Here you can invest your money at any point of time, withdraw your money back at any point of time. There is no restriction in terms of lock-in, the minimum amount of time that you have to stay. It is recommended that you invest for at least 7 days and post that you withdraw your money if you do need so. If you do withdraw your money, typically settlement happens on a T+2 basis. That is, if you withdraw your money on a working day, you get your money back in 2 working days from that. Then we have lock-in schemes starting at 3 months, going all the way up to 36 months. So 3 months, 6 months, 12, 24, and 36. In each of these, the rates are the ones that you see on the screen. The 24 and 36 are at 10 and 10.5. These are simple interest. All of the others are on an XIRR basis in terms of return. And then we have a flexi lock-in, which is a double advantage scheme, where if you invest for a 12, 24, 36 month period, you get the expected IRR, which is 9, 9.1 and 9.25 if you stay invested. But you have also the option to withdraw it prematurely or before time. If you do withdraw, you do not have an exit load, but your returns dip down marginally. Instead of 9, you make 7.25 in the first year, 8% in the second year, and 8.5 in the third year. Minimum investment value is 10,000 rupees. So if you're starting an account and investing, the minimum that you need to invest is 10,000 rupees. The maximum that you can invest as per RBI regulations is 50 lakh rupees. And for all of the schemes that you see above, be it liquid, be it lock-in, be it flexi lock-in, you have an option to take a monthly interest payout, which is that if you invest 5 lakh of rupees, us amount pe jitna bhi interest bana during the month, you can withdraw or gets automatically credited to your bank account within 2 days after the end of the month. Or you can take it a cumulative option for compounding of those interest also that you have. Now we've covered the return part. Let's also look at the risk part. And here is where I'll go into detail in terms of how we've tried to mitigate most of the risks that exist with any fixed income investments and P2P investments in particular. So first and foremost risk is counterparty risk. If you're not directly lending to the borrower, what is the chance that whoever you've lent your money to or whoever you subscribed in terms of an NCD is using the funds for the intended purpose. So a prime example of this is DHFL. DHFL में जो loans DHFL ने दिए थे, most of those loans performed well. But the issue was not that the underlying loan book was bad. The issue was that some of the funds were not used for the intended purpose. They were lent out to fraudulent entities or to promoter-linked entities. So that part of the book went bad. So it was an issue where funds were not used for the intended purpose, and there was some counterparty risk in terms of usage of the funds. That risk RBI has completely mitigated. Even a single rupee that you lend or invest onto the platform does not come to our current account. It is not a balance sheet exposure to us. We are not free to use that funds as we deem fit, as is the case with any NCD or FD. वो पैसे we can only and only use for lending to borrowers. And all of this structure is ring fenced via an escrow and trustee mechanism, where funds do never come to our balance sheet. They always go to the escrow account, which is managed by a trustee. This trustee in our case is a PSU bank entity, which is IDBI Capital. So at no point of time can we use the funds as we desire. Second is concentration risk. अगर आप 20-30 हजार रुपए भी डाल रहे हो, in the best of mutual funds or debt mutual funds, that money will get diversified across 20 to 40 names max. Here, even if you're investing 20,000 rupees, that money gets diversified across at least 200 borrowers, which means your average exposure to one borrower is below 0.5%. Credit risk I've already covered in detail. Interest rate risk, again, an important risk in fixed income investments. What is the likelihood that your investment faces a mark to market or MTM hit if interest rates move up or down? जो debt mutual funds में होता है, as you would have seen in the last year as RBI has increased rates, some of the debt mutual funds have faced a mark to market loss. In our product, there's no mark to market loss. If you invested in a scheme at 9%, if rates move up, rates move down, there is no impact on the investment. You will continue to earn 9% as long as the borrowers perform well. Finally, and most importantly, I think this is the key takeaway of this entire slide. There is extremely high alignment of interest with Liquiloans with all of the investors who are investing on the platform. So we as a platform do not make a single rupee of income, do not earn a single rupee of revenue until each and every investor or every investor makes their full principal and full return back. So if you have invested a lakh rupees on the platform, आपका जब पूरा principal, पूरा interest वापस आ जाएगा, उसके बाद जो बचेगा is our fees. So we as a platform are last in line to make a single rupee of revenue. So if your return is 8.99% instead of 9%, that means we as a platform or a company have made zero revenue on your own. Our revenue only and only starts if your income is earned full, including principal, including interest. This is unlike any other product in the country, right? A mutual fund continues to charge you an expense ratio, no matter the fund, whether the fund performs well or performs badly. So the upside is also yours, downside is also yours. In our case, we are saying you make the first X% return, and only then do we as a platform start earning any kind of revenue. This slide will just give you what is the level of margin of safety because of this construct. So as a platform, we say we will effectively bear the first loss. Currently at the platform level, our gross NPAs are 0.79%, right? So again, there's a misconception around P2P lending ki risky hai, kaun se borrowers ko dene hai, jinko nahi milta hai. This will tell you the story. Across the last 5 years, including COVID period, our current NPA is just 0.79%. ICRA has evaluated this entire portfolio. They have said the maximum NPA that you will see in a similar portfolio is just 1.23% in normal times. And the peak that we've reached to, which is the graph that you see on the left, is during COVID. We went from below 1% NPA to 1.63. So even in the peak of COVID, wave 1, wave 2 combined, our maximum NPA was just 1.60%. And uske baad se it has consistently declined. That again tells you that the quality of borrowers that we are catering to and underwriting are of very high quality and caliber, that even during COVID, they were not impacted. Hopefully, this is the worst event that we see in our lifetimes. And if it's been stress tested through that, then you can imagine that the quality of the product and quality of underlying borrowers is very high. So let's take even the worst case estimate that ICRA has made, which is 1.23% expected loss on the higher end. From there also, you have a 10x margin of safety. So even if that number were to go up by 10 times, 12.3%, the total margin of safety before you start losing a single rupee of interest is 13 to 14%. So even at 10x of what ICRA has said, each and every investor will earn their full interest return. So this quickly just tells you why some of our existing or early investors have liked us, right? So one, this product acts as a true source of diversification. It is not linked to equity markets. It's not linked to debt markets. It's not linked to crude oil, gold, what is happening in Russia, what is happening in the rest of the world. These thousands of individual borrowers will continue making their payment nevertheless. There is very high certainty of returns and extremely high margin of safety. One of the only products in fixed income which is able to generate an inflation beating return, right? So today you have to be cognizant of the fact that inflation continues to remain in the 6 to 7% range. Any product which is not generating a net return beyond that is actually losing you money on a year-on-year basis. It again has an option for liquidity, one of the very few products in fixed income which give you a liquidity option. And we also have an SIP option. So you can keep saving on a monthly basis for this product. And then once you build a corpus, you can either transfer that to equity or use it for any expenses that you might have. One of, again, the only products in fixed income which is able to give you a good monthly interest payout, which you can use for your expenses. So you can invest 5 lakhs, 10 lakhs, 15 lakhs. And usse jo interest aa raha hai on a month-on-month basis, you can use to either do an SIP in equity or you can use it for meeting one of your fixed expenses. And again, now debt MF indexation has gone away. So any investment that you make even for 3-4 years is taxed at full as full interest income or at the marginal rate. So any goal that you have in the next 2-3 years, typically you can't park that money into equity, right? Because you don't know market kahan hoega after 2-3 years. It could be higher, it could be significantly lower. If you have a fixed goal defined, which is a fixed cost, that money necessarily needs to go into fixed income. Our positioning is that it is one of the better propositions within fixed income because you're able to generate 3-4% higher than most other products. Quickly on the performance side, we've disbursed 2,900 close, or this month we'll end up beyond 3,000 crores of total disbursements since inception. Gross NPAs continue to remain below 1%. Net NPAs is 0. So not a single investor through COVID, before COVID, after COVID, in the worst of the scenarios, has even seen a single basis point decline in return. Total borrowers on the platform is over 7 lakhs. And anyone who's requested for a withdrawal has got his money back in T+2 days in the liquid scheme. Not a single case where we've not been able to provide liquidity. And Piyush, that's it from our end. We'll just open up the floor for Q&A.
Thank you so much, Gautam. Now you participants can post the questions in the chat bar. Nitish, if you can read the question and then Gautam can answer or take up those questions. So Gautam, till we have questions from the participants, I have one question. Say someone is investing in Liquiloans as to someone investing in a NBFC who is focusing on prime borrowers, who is also lending to prime borrowers. So what is the difference in terms of safety and in terms of return expectation?
Sure. So one, Piyush, I think most NBFCs or established NBFCs today will be lending across segments, right? So someone as qualified or as great as Bajaj Finance will say they are lending across multiple segments, be it prime borrowers like we are doing, and at a much larger scale, obviously, but simultaneously what 2-wheeler, 3-wheeler loan bhi kar rahe hain. Then they are doing SME loans also. So you will find it hard to be able to locate a large NBFC which is established, has a consistent track record, which is catering only to prime borrowers. The other risk with NBFCs, and this is not speaking negatively or positively about any specific NBFC, from a model perspective, when you do an NCD with an NBFC, that NBFC then is by and large free to use the funds as they desire. You as an investor cannot ask them any questions, कि पैसा कहाँ लगा हुआ है, कौन से type के loans में गया, and so on and so forth. That entity has said, I will pay you a 6% or 7% or 8% return. And then they use the funds in the manner that they desire. So this, again, most NBFCs do not end up misusing this, but there's a possibility that issuances or instances like DHFL happen where those funds are not used appropriately. So that is one level of risk that exists. The probability investors are better placed to ascertain and decide, but that risk is completely eliminated in a P2P construct, which is an evolved version of an NBFC in the eyes of the regulators. From a return perspective, again, as you would see here, returns, depending on the NBFC you look at, the vintage, it's not an apples to apples comparison. If you do an apples to apples comparison of entities which are of particular risk in terms of the underlying book, we will generally be 2-3% higher because it's a purely digital platform which eliminates a good percentage of the operational costs. We do not have a lot of branches as would be the case for most large NBFCs. Even in the borrowing side, we tend to follow a tech-based approach where we don't have to put a person on the shop of the dealer or the merchant. That reduces the cost. Some part of that cost savings are what we are able to pass on to the investors in the form of return.
Can we
Thank
take
you,
up the
Gautam.
question?
Yeah. Yes, Nitish, go ahead.
Can minors invest in this fund?
No, minors can't invest. This is allowed or open only for people who are 18 years of age and above.
What is the difference between gross NPA and net NPA?
Sure. So gross NPA is typically, let's say we have lent 100 crores of rupees, 100 crores of rupees over the last X number of months. If 1 crore worth of borrowers or people who have 1 crore worth of loan outstanding default on that, gross NPA is about 1%. In our case, the net NPA concept is the following, where we say if any of our lenders had to bear a cost in terms of returns due to that 1 crore worth of borrowers defaulting, then that will reflect in net NPAs also. If that 1% gets adjusted against our fees, which is the case as you would have seen in the margin of safety slide, then that impact of that NPA is not borne by the investors. So effectively, an investor who invested at 9% and onward lending had happened at, let's say, 15%, 8% ka NPA. So our fees comes down from 15 minus 9, which is 6%, to 14 minus 9, which is 5%, which means the net impact or the net NPA to the investor was 0, even though the gross NPA was 1%. So that's the concept or differential between gross and net NPA.
How are the asset versus liability mismatch managed?
Sure. So typically, from our perspective, there's an asset liability mismatch concept or equivalent risk that exists only in the liquid fund. Most of the other funds, as you would have seen, are locked in. So let's compare what happens with a large bank. A large bank takes 2 types of deposits from you: savings account, which is anywhere withdrawable at any point of time, and a FD, which has a fixed tenure. But almost all the FDs that a bank does are withdrawable in nature. Kal aap jaake, main jaake, jitne bhi investors hain of the FD can go and ask for return. Obviously, you'll get a lower return that was initially envisaged, but you are able, there is no restriction on your ability to withdraw the funds. At the same time, the bank lends money to borrowers who have a fixed tenure. The bank can't go to a borrower and say, because my withdrawal or depositor has come, please repay back the entire fund. So if someone has taken a home loan, he will not have the capability to make the entire home loan payment at one go if the bank so asks. So this is the concept of ALM risk that exists in any financial investment or any financial lender, not just India, but globally. Now, this you will never be able to mitigate completely. What you can do is minimize this as much as possible. So in our case, what we've done to the gentleman who's asked this is we've ensured that a large percentage of our funds, almost 2/3 of our funds, are in the lock-in schemes, which means those are not withdrawable on call by the lender. They can only withdraw them after the maturity of that day. And only about 1/3 of the funds are in the liquid fund. A lot of our lending is also not a 10-year, 20-year home loan lending. As you would have seen, most of our loans are 6, 12, 18 months in nature. So every month, a good amount of repayment is coming back, which ensures that if and when anyone puts in a withdrawal request, there is ample liquidity in the system for him to get his funds back. Now, this is the theoretical answer. Practically, we've seen a stress test of even the liquidity model or ALM model during COVID, where we had 80% of our investors or lenders who had put money into the liquid fund, and a lot of them came back for withdrawal. क्योंकि किसी का medical emergency था, कोई डर गया कि what will happen to my investments. Someone had a margin call in their equity portfolio. So for n number of reasons, people withdrew at that point of time. Even then, each and every investor who asked for a withdrawal got the withdrawal within T+2 days with full principal plus full interest repayment.
Can NRI invest in Liquiloans?
Yes, so NRIs can invest, Nitish, but only through their NRO account.
And there is a question from another person. Can trust invest in this?
There's some technicality. Arindam, could you just check and respond separately? We'll want to take this offline. I think there are certain segments that are allowed, certain segments that are not allowed. I do not remember them offhand, so I don't want to comment.
Okay. Sure. Is P2P similar today to what mutual funds were 20 years back?
In what context? So I think in terms of just the nascency of the industry, yes. There was a similar amount of concern around mutual funds. Kaise operate karte hain, kya karte hain. Level of education was similar. So from all of those contexts, it was similar to where mutual funds were 20 years back. Hopefully, our journey will be faster than 20 years because there's now education advisors like yourself who will be able to educate and explain investors better. And investors have become smarter, right? There are enough number of online resources available for anyone to do their own research. So from a context perspective, yes, I think even from a optionality to the investor. Prior to mutual funds, you had very few investment options, gold, or real estate, or FD. Mutual funds opened up a whole new avenue for investors to be able to invest into. From that perspective, I think we're at a similar point in the fixed income market. The fixed income market, you have bonds, you have FDs. None of them are as lucrative as they were in the past, right? When returns were double digit on most of these products. Today, you will need to venture out beyond that safe zone and try out products like P2P. And I would say, like, from a risk perspective, it's not necessarily risky. It's just the evolved version. As technology comes in, you're able to bring down the cost, pass on that return to the investor without compromising. Typically, your risk return spectrum hota hai ki only if you take higher risk will you get higher returns. That can be appended by solving for it via technology. Where we're saying we are lending to the best of the borrowers, like you saw on the ability slide. We are lending to borrowers or customers of HDFC Bank, ICICI Bank, and sometimes higher. Our customers are not going to default. So if you can lend to them at a 2-3% higher rate than most other products, you are bound to make the return without compromising on risk in any meaningful manner whatsoever.
So next question is, what is the main moat of this business? Other than being the first mover, what is the edge and competitive advantage that Liquiloan enjoy that competitors won't be able to copy in future?
I think so. Anything that is, see, in the finance domain, nothing is patentable or you can't do an intellectual property protection on anything that you do. So the model can be copied. In fact, to be fair, it is not a model that we innovated. We have also copied the model from Bajaj Finance to a certain extent. So there will be replication of the model. What differentiates is your ability to underwrite. There is a reason HDFC is trusted beyond tens of hundreds of housing finance companies that exist in the country, right? So there will be players in the home loan space who are at 1% NPA. Same in the same space, someone might be at 4-5-6% NPA. So the quality of your underwriting, the team, like the chief risk officer for us is someone who has done underwriting at Lending Club, which is the largest P2P player in the world. He has looked at books of disbursements of $10 billion plus per year. So they were at a scale larger than HDFC is in the country in terms of personal loans, and through a fully automated process 5 to 7 years back. So like a decade ahead of India. So we've assembled the right team. I think that edge will continue to remain. And there is a constant amount of relearning in the system, right? Once you have, as you would have seen, we've disbursed loans to 7 lakh plus borrowers. अब उनका जो रिजल्ट आया उसके लर्निंग की वजह से our model or algorithm becomes stronger and stronger over the period of time. It becomes hard for the new player to catch up with that. Not to say it's impossible, but it's not going to be easy. And finally, investors will look at track record, right? We have a track record through COVID of this model. Someone were to start this model today, you will say the model is the same, but it is untested. Only over the next 10 years, 15 years, if you go through a bad cycle as COVID, will that model get stress tested to that extent?
There is another last two questions that we'll take up. Any plans for products to compete with 12% offered by some other P2Ps?
Not currently, right? So again, P2P should not be painted with the same brush. You have to go deeper and see what is the risk and return. Like with all banks are not the same. There are banks who are giving an FD today at 5%, and there are banks that are giving an FD at 9%. The ones that are still giving an FD at 5% tend to still get the highest allocation, right? The ones that are riskier have to offer a 9% rate. So is the case with NCDs. There will be companies who give an NCD or issue an NCD at 7.5%. There will be some companies who are issuing an NCD at 12-13% also in the market. And these numbers are transparently available on the NSE website. You can log and see them. So P2Ps are also similar in a certain context, right? You have to see ki paisa lag kahan hai. Is the money going into a large cap borrower equivalent, which is our case, or it is going to small cap? Not to say one is better than the other. It is a function of the risk appetite of the investor. Whoever has a small cap or thematic fund appetite from a risk perspective in mutual fund should put money there. Expected return is higher. But if you put money into a balanced advantage fund or a large cap fund, your returns are likely to be lower, but your volatility is also likely to be lower. So if you are someone who wants a safe, consistent, highly predictable return to your fixed income investment, that is where we will win. But if you want a slightly higher edge and you're okay for the higher risk, then some of the other platforms will win. So in the short run, we don't intend to go down the risk curve or increase the risk in the investor's portfolio. Over the next 2-3 years, once we feel the industry has matured to a certain extent, we might.
So the last question we'll take up is, what is the risk that the company in future may not go for subprime lending, a bit for growth?
Right. So if we do that, Nitish, like I think luckily the previous question was around that. If we do that, we'll put that into a different scheme. Same scheme में mix नहीं करेंगे. We'll say this scheme is catering to prime borrowers. This is a subprime scheme. उसमें risk भी high होएगा, return भी high होएगा. So it is important the platform does not intermingle, right? That is one core responsibility of the platform. Where if you have launched a large cap fund, you don't invest money from that into small cap. You launch a separate small cap fund, and then investors will decide where they want to invest their money.
So I think that is today. That is all for the questions for now.
Thank you, Nitish, and thank you so much, Gautam, for taking time out for this insightful session on P2P. I know you keep very busy. Thank you so much again for taking time out. So now I would request all participants, if you have any further questions, you can reach out to me offline one-to-one, and we can discuss and take it forward. If you have any further questions, or you want to know the process, how you can get started with investing in Liquiloans or P2P. So thank you so much thank you so much everyone for attending this webinar and making it a successful one. And we intend to run such webinars every month on different topics. You will hear from us again soon on the next topic, which will be running the webinar in the month of July. So thank you so much. Gautam, any words, any ending words?
No, I think I'll just like to thank all of you all. So thanks all the participants for coming out to the webinar and being so patient. And thanks Piyush and Nitish for the nice things.
Thank you so much. Now I will end the webinar.